Okay. Good evening, everyone, and thank you for joining our webinar this evening and carving out some time to help understand how policies actually will respond to your specific losses. We believe that education is the key, especially in the front end of these type of events. The more you know now, the better off you'll be down the back end. A little bit of introduction of myself. My name is Reno Benenati. I am one of the vice presidents of the Greenspan Company Adjusters International. I've been in the business as a public advocate, public adjuster for about 30 years, going on 31 years. I've been involved in pretty much every firestorm in recent history, very versed in these things. Unfortunately, we're starting to see it all too often. Greenspan itself is the oldest and most respected public adjusting firm in the country. We've been in the LA area for 79 years, huge footprint here. And these webinars are a way of giving back to the community that has given back to us for so long. And we're very grateful. And again, this is our way of giving back to the community and sharing 79 years of knowledge and history with representing policyholders. Before we begin, I want to acknowledge the incredible devastation and emotional toll this has taken on everyone involved. It is absolutely catastrophic, and our heart goes out to each and every one of you. And we're hoping that the information that we share this evening will help lessen some of the burden and guide you down the path to recovery with having some answers to the tough questions. Our Q&A will be available after the slide presentation I will give. And with that said, let's begin. There's a couple of common misconceptions we hear quite a bit. The first one is I have a policy, I've paid all my premiums. My policy limit is X, whatever that is. This is what the insurance company will, the policy limit is X. This is what the insurance company will pay me, right? Well, in a perfect world, that would be great. You would think that they would do that, but the reality is that you have to prove what your losses are. The burden of proof is on your shoulders, not the insurance company. Remember, you're the claimant. You're making a claim for benefits for money against this contract that you bought, hoping you would never need to use it, but now you need it. And simply having a policy and paying the premium doesn't guarantee that you're going to receive the full policy limit without it being justified. So again, as a claimant, the burden of proof is on your shoulders, not theirs. And on that topic, there's no law that I'm aware of, and I'm licensed in over 20 states, that mandates that an insurance company has to be accurate in the measurement of the loss. And so again, that burden of proving it is on you. And in the absence of doing that, you allow them to do it. And they don't have to be accurate. And so we see a lot of times where there are errors and omissions made in these estimates and these scopes of repair. So it behooves you to really dig down and understand that that burden of proof really relies on your shoulders. The second misconception we hear a lot is my insurance is being really cooperative and they put me in a temporary residence. Well, look, the insurance company is legally obligated to provide these advances and accommodations as per your contract. This doesn't necessarily mean that they're cooperating beyond their legal obligation. As long as they're operating within the four corners of the contract, I call it a contract, it's a policy until you trigger it with a claim. So I'll be using the term contract as opposed to policy. And so they're operating within those four corners. And I would urge everybody to order a certified copy of your insurance policy. That is the rule book, folks. And if you don't have the rule book, you are not in the game, because the adjuster may cite a certain area of the policy when you have a question, or if there's a denial or some kind of issue that arises. And if you don't have the certified copy to reflect upon, you are at a disadvantage, period, because they have the rule book, they wrote the rules, and you're trying to understand how to play the game, so to speak. So the policy, again, is a contract, and you are, and they are, subject to the terms and conditions, definitions, and endorsements of that contract. And again, the better you understand those terms and definitions, of which we will be going over some today, this evening, the better off you're going to be. And then you can't rely on the insurance company to educate you how to get more money out of them. It just doesn't work like that. They're a for-profit industry. And as such, the more they pay out, the less they have for themselves. And and again, you want them to operate under the conditions and definitions of the policy. So we're going to get into these slides and the breakdown of how these coverages actually work. Most of you have looked at the policy, and if you haven't by now, I would strongly urge you to understand that policy contract. So there's 4 buckets of coverage, and all these homeowner policies break down this way. Of course, commercial policies are a little bit different. A, B, C, and D is how most of them are listed out. A being the dwelling. That is the meat and potatoes. That's the big one. And under that bucket A, if you look at the green bubble dot there, you'll see these other coverages. These are sub coverages within the A bucket. And some of those are extended replacement costs that are part of this. Also, code upgrades falls under bucket A, debris removal, and landscaping. So those 4 other coverages are part of the dwelling coverage. Coverage B is other structures. Anything that's detached from the main dwelling would be considered other structures. And that would be pools, cabanas, sheds, driveways, walkways, retaining walls, exterior lighting, garages, workshops. Again, things that are detached from the main dwelling is considered other structures. And under that bucket of coverage, there are sub coverages as well. Trees, extended replacement cost endorsement may apply. Code upgrade is part of it, and debris removal also falls under bucket B, other structures. Bucket coverage C is personal property, and the way we look at it is before the fire, if you were to peel off the roof of your house, tip that house upside down and shake it, whatever falls out would be considered your personal belongings. Whatever remains behind is attached to the ceilings, walls, and such. That goes under bucket A, dwelling. So personal property, under that bubble dot, you'll see scheduled items. And those are things that you buy extra insurance for separately under the personal property bucket. You may have extended replacement cost endorsement that kicks up those numbers. We'll be talking about all these terms as the webinar continues. You'll have debris removal coverage as well. And 4th and final bucket is loss of use or the additional living expense or fair rental value. And that bucket basically covers your temporary housing for the period of restoration. And that has housing, your furnishings, they rent furniture for you, animal boarding, boat storage, and it covers extra mileage. And again, we're going to get into these separate coverages in depth and talk about the options and coverages and how they apply to losses. Now, a lot of this would be either for smoke loss or total loss buildings. Next slide, please. So we're gonna go right in order, just like we showed on the last slide, A, B, C, and D. So this slide, we're gonna use the base limit of $2 million. If you look at your declarations page in your policy, you'll see a dollar limit, which we call the base limit for the dwelling. And if you look to the left of the slide, you'll see the sub coverages, extended replacement cost. You've got code upgrades, debris removal, and landscaping. Again, all those fall under the coverage A. Now, most of the time, these are additional, well, pretty much all the time, they're additional coverages. But again, look at your policies. Sometimes they're built in. Things change within the policy sometimes mid-year. So getting into the slide, we're going to use an example as a $2 million base limit. Now, under base limit, you see $1 million. That's an extended replacement cost endorsement. In this example, it's 50%. Some of you have 20%, some are 25%, some are 50, and some are up to 100%, which doubles it, goes up to another 2 million. So in this example, we're going to use 50% extended replacement cost. That's additional coverage should it be found that the damages are measured greater than $2 million. Then the door opens up, if you would, to this extended replacement cost coverage. So again, I'll repeat that. If the measurement of the loss, for example, comes out to $2.5 million and the insurance company agrees, then what happens is it will trigger the extended replacement cost. It'll open up that coverage. And then again, in this example, we can tap into an additional $1 million of coverage. That's the extended replacement cost. Now, there are triggers to get that, and we're going to cover that in the next slide. So under that, you have code upgrades. And code upgrades talks about ordinance or law coverage. And these are the insurance company owes you for what you had at the time of the loss, plus the extra money it will cost to bring it up to today's standards. And an example would be Title 24, energy efficiency, fireproof roof tiles and decking materials, certain R rating, double pane windows, things like that are code upgrades. Now, they do vary from county to county. They're not all the same. And after a firestorm, our experience has shown that the codes will change again. They want to make things more fireproof, more fire retardant, and more robust. And so code upgrades will definitely come into play. And most policies have 10% of the base limit. That's how it's calculated. And some policies give you up to 100% of the base limit. Now, in this bucket of coverage under the code upgrade, I would say the more the merrier, because what you don't want to have happen is where you may have, in this example, $200,000 available for code, but the code trigger is $300,000. Now you're upside down. So you want to know what your code upgrade coverage is, and hopefully you can fit everything into that parameter, because you don't want to fall short. Under that, code upgrade is then debris removal as part of bucket A coverage. And that's a hot topic. We're going to get into that a little bit later. That's usually 5% of the base limit. As you can see, everything bounces off of the base limit. So these percentages are always taken off of the base limit. So debris removal is usually 5%. In this case, this is $100,000 available for the debris removal. Also under coverage A, you have landscaping, and that's 5% of coverage A. That's where we got the 100,000. Now there's a little caveat to that. So you have 100,000 available, up to 100,000, but what they do is they limit it to either 550 or up to 750 per tree, per bush, per shrub. So you count the trees, and for those of you that have acreage or beautiful landscaping in and around the property, and it is not cheap landscaping. So you want to count the trees, count the bushes, the shrubs, and then look at what your limitation is under that limit. So again, 5% is the overall limit, but it's subject to 550 or 750 per tree, per bush, per shrub under the landscaping coverage. Now, some insurance companies have an endorsement that gives you an additional increase due to a declared catastrophe, which this is. And so we know, for example, Safeco has this endorsement, and you look for it, it's in the contract, and that kicks up the numbers either up from 50 to 100%. So if you can imagine, now your base limit is 2 million with the extension, with the extended replacement cost, now you got 4 million. And so it's really important that you look at these separate little coverages, because they're all in addition to, and you want to make sure that you're able to maximize these recoveries. Knowing how much you truly have all in will help you with understanding how to get it all put together. Now, if the bottom line at the bottom number there is 3.4 million. So we went from 2 million, and then we've uncovered another, $1.4 million in coverages in this example. I hope that was clear, but this is the big meat and potatoes bucket, we call it, the dwelling. That's going to be your biggest money bucket, so to speak. And one of the most important, certainly, it's your primary residence. We're going to cut now under coverage A. You have three options. And those three options are either you don't want to rebuild and you're going to cash out and you're going to go rent a bungalow by the beach somewhere, and that's where you're going to live for the rest of your life. That's an option. And we call that a cash out. The second option is you purchase a replacement property. That's a house that's already built. You can do that certainly as a replacement. And then the third option is you rebuild on the site. Those are the three options that you really have under the circumstances of a total loss. So going into the no rebuild coverages, we have that same $2 million example base limit. And then we talk about what are you entitled to if you cash out, or what are you leaving behind if you choose any one of these three options. So you do have the debris removal under no rebuild. You are entitled to that still. 5% of the 2 million is 100,000. You are entitled to landscaping, the 5%, which is another 100,000. The extended replacement cost, if you notice, it's blank, because the caveat to qualify for the extended replacement cost is that you have to spend the money. You have to perform to get that money. They may agree that they owe it, but unless you spend the money, folks, you are not going to be able to capture that money. And so if you do a cash out and not spend the money, then you're basically leaving that benefit behind. Now, there's one or two companies out there, I cannot mention names, that have made a management decision to pay the extended replacement costs, the code and everything, all in with no performance necessary. I suspect that's a management decision at the insurance carrier, and it's a great PR move if you think about it, really. So now moving still on the no rebuild line, going down, the additional increase due to declared catastrophe, you wouldn't qualify for that. And the code money, you're going to leave that behind as well. So the extended replacement cost, again, under no rebuild is left behind because you have to perform to get it. You have to show them that you're spending the money and they'll pay it up to the agreed amount. The code upgrade, there's two triggers that make that happen, the code for coverage. One is it has to be mandated by the building inspector. The building inspector will mandate certain codes to be triggered, and as long as you have that in writing, that gets sent into the carrier, and they don't supersede the law. So basically, they have to pay it up to whatever limit you have. And so that's the first trigger to get code, is it has to be mandated by the building inspector. And the second is that you have to spend the money. So that's a reimbursed type of expense, as is all your soft costs. Soft costs are permits, architectural and engineering costs. All those soft costs also have to be expended in an effort to get it. Now, again, unless you're able to negotiate, and we've had some success in the past negotiating settlements where, in just positioning things differently in an effort to collect code and extended replacement costs without performing. Very rare, but it can happen. I've seen it in my 30 plus years of doing this once in a while. So that's what happens on the no rebuild. If you choose not to rebuild, it's a choice. We all make choices. And if you choose that, those are the consequences, good and bad. If you, on the second middle one, purchase a replacement property, certainly you can do that. If you don't have the wherewithal to wait a few years and go through this whole rebuild process and wait for your community to get rebuilt, then a lot of people will choose to take the money that's committed to from the policy and go buy a replacement property that's already built. Now, these benefits will follow you anywhere in the country, folks. You don't have to rebuild right or purchase right in that neighborhood. They follow you anywhere in the United States. So again, with the base limit of $2 million in this example, again, the debris removal, yes, you are entitled to that. Landscaping as well. Extended replacement cost, yes, you are entitled to collect that. So if the replacement property is, for example, $3 million, then you collect that. Once I believe once you're in escrow, you'd have to find out your carrier specific requirements, but you are entitled to collect it in an effort to put it towards a replacement built property already. The additional increase due to catastrophe, you'd have to check the language of the policy and see how that responds specifically when you purchase a home that's already rebuilt as a replacement. And yes, you are entitled to code. In this example, again, it's 200,000, which is 10% of the base limit. So as you can see, there are requirements in an effort to collect all the money. Lastly, the rebuild on site, same thing as the purchase or replacement home. Nothing changes. You're really not leaving anything behind. And again, the reason there's question marks on the additional increase due to a declared catastrophe is because we don't know if it's in your policy or not. You'd have to check. But I would imagine it's definitely part of it and should be covered as such. So those are the three options that we see people have when you have this type of situation, whether it's a total or a smoke loss. But most smoke losses, we find people, clean, fix, do whatever, and then move back in because basically the neighborhood is pretty intact at that point. And those are the three scenarios under dwelling. Second bucket is that coverage B of the structures, garages, workshops, detached fencing, retaining walls, etc. Again, anything detached from the main structure. Before I get into this slide a little more, I want to mention a couple things. For those of you that have a mortgage, it is very critically important to contact the loss draft department. LOSS as in Sam, loss draft department. What that is a little department in every mortgage company, and their sole function is to take in settlement checks that come in from fires, floods, earthquakes, hell and brimstone, whatever has happened to cause a settlement check to arrive. When you call the loss draft department, they all operate a little bit differently. Their protocols are different. So Wells Fargo, B of A, Mr. Cooper, they're all a little bit different. And what I would ask you to ask them is you want to find out what is it that they need to set up your file, because you want to do this proactively. You don't want to wait till the end once a settlement check comes in and then this file has to be set up. It takes quite some time. Sometimes it takes 30 days, 45 days to get things going. So you want to set all this up proactively, call the loss draft department and ask them, what is the protocol for you to release the money back to me when that check clears? Now, what happens is, let me walk you through this. Settlement check comes in with your name on it or the LLC or however it's listed as the named insured. And if you have a mortgage, the mortgage company's name will be listed on the check as well. This is for the dwelling and other structures. And the reason they're on it is because they have an insurable interest on that home. They're your partner. They lent you money to buy this place. So they have an insurable interest only up to the amount of the outstanding note. So for example, if you have $1 million settlement check and your mortgage outstanding is only $500,000, they're going to want to control and dole out and control that $500,000. They cannot control the whole million unless you have some kind of manuscript mortgage that is different. Otherwise, most mortgage loss draft departments will take that check, you'll sign off on it, it goes to loss draft, they're going to put it into an escrow account, and once that check clears, they should give you and will give you the difference. In this example, you have $1 million settlement check. You only owe the bank, the mortgage company, a $500,000. So once that check clears, they're going to release $500,000 to you. That's the unencumbered amount. The encumbered amount is the one that they get to control. Now, remember, it's your money. They're not keeping it. They're going to dole it out to you, usually in thirds. And again, every mortgage company has different protocols. So you want to find out what that is so that the transaction of the money coming in and out is smooth and efficient. And being proactive is the key. So if they dole it out in thirds, you get a third to start the project. Once you run out of that, you call lost draft. They'll usually send out some representatives to take some photographs of the project. They want to make sure you're spending money on the project and not going to Vegas, trying to double it, or buying a vehicle. They have, it's a collateralized loan. They want to make sure that that money's going back into the dwelling and the property. And then they dole out another third. And again, there's different requirements for different lost draft departments and mortgage companies. They usually need two pieces of documentation from you guys. One would be a signed contract with a licensed contractor. Secondly, they'll usually want the adjustment figures. They want to know how these numbers came to be. Now, some mortgage companies may want additional information. So again, call lost draft, find out what they're going to need, get your file set up. They may send out a package for you to fill out. And that way, when that check arrives, you can sign it, send it off, and things start moving fluidly. Okay, that was just something on an aside. Now, getting back to slide B here, coverage B, base limit, that's 10% of the 2 million. You may have extended replacement costs on other structures. Again, you'd have to read the policy. Debris removal is covered. If you think about the debris field, folks, it's not just the dwelling. It's the dwelling, it's the personal property, it's the other structures, it's the fences, it's the retaining walls. It's a lot. And so debris removal also should and would apply in this case to other structures. You also have code upgrades. If you rebuild your workshop, your 3-4 car garage, what have you, that's going to need to be brought up to code. So there's code coverage available as well under coverage B. So the total goes to 230,000 in this case. Now, also while I'm on this, I want to mention walkways, driveways, patios, sprinklers, pools, and cabanas. If some of these areas are salvageable, meaning they're not spalled, and for those of you that don't know what spalling is when it gets so hot, the temperature outside and the fire is blowing over the property, it wicks out the moisture out of the concrete, rendering it brittle, and it's no longer has its tensile strength. They call that spalling. Now, for those of you that don't have spalling on the driveways and walkways and you want to salvage those because they have value to the property, then some people during the debris removal program will take sheets of plywood, the 4x8s, lay them down. That way, when the bulldozer comes up, they're not damaging it. And again, just things to think about that can salvage your walkways and driveways if you want to do that, and if they are deemed salvageable. Okay. Take a sip of water here real quick. Okay, personal property. Personal property is one of the most daunting. I always say it'll take years off your life, folks, if it's not handled properly. It's emotional, it's personal. And when you go through your personal property claim, it is the hardest thing to do. It is the most time consuming, the most taxing emotionally, part of this claims process that you'll find that we get calls all the time. Months and months later, people venture out onto trying to, embark and doing this on their own, and then they throw in the towel. It's a lot of work, and I'll get into why it's a lot of work on the next couple of slides. So in this example, personal property limit is 1.5 million. That's your base limit. You may have sublimits, and sublimits are things like watercraft, cash. BPP means business personal property. Now, under the personal property homeowners coverages, the business personal property is limited. Some policies only give you up to $1,500. Other policies are $5,000. And for those of you that operate a business out of your home, understand that you want to separate the business personal property from the regular daily personal property that you use, because it's going to be subject to a limit. For example, if you have a computer in your home office and you use the computer 80% for work and the rest of it, the 20% for personal use, then 20% of the value of that should be shifted over to the $1.5 million bucket, the personal property bucket. So keep that in mind, that business personal property is definitely a separated type of sublimit. Cash, things like that are also, and it'll be listed on your policy under special limits section. Scheduled items are jewelry, furs, artwork, things like that, that you take out and buy additional insurance that attaches onto your existing homeowner's policy that schedules the item. Scheduled simply means there's a value, appraised value on it. For example, you have a jewelry that's $50,000 ring, and you want it separated and insured separately, that they agree to pay that $50,000 should the thing get damaged, then that's what a scheduled item means. And so look for that. That should be part of your policy, of course, if you've paid extra to schedule items. Now, below that in red, you see the ACV. That means actual cash value versus RCV is replacement cost value. Whether you like it or not, folks, you're going to be subject to these terms and these definitions. And so it's best that you know how to use them now and understand them. There's a difference between ACV and RCV. Most homeowner policies are calculated on RCV, replacement cost value. And I'm going to get into the depreciation in a moment. Let's talk about actual cash value and replacement cost value. There's a huge misconception. This is probably the third one. We should have added it. That people say, I have a replacement cost policy. Don't they owe me all of it? Well, the answer is yes, but here's how it works. You have to get the insurance company to agree to what the replacement cost value is of the item. So let's take a couch, for example. You have a couch, it's total loss. And that couch, you bought it for $6,000 a few years ago. But due to inflation, now it costs $10,000 to replace. So the replacement cost now is $10,000. It doesn't matter what you paid for it on sale or if it was gifted to you from a family member or inherited. It's what it costs today to replace, period. That's where that number starts. You got to get them on the hook for that number. Then it's subject to depreciation for wear and tear, age, condition, obsolescence, things like that will reduce the replacement cost value. They have the right to do that. And the number it drops down to after depreciation is applied is actual cash value, otherwise known as fair market value. So let's use that example. So we have the couch, we bought it for $6,000 years ago. You lost it in the fire. Now it costs $10,000 to replace. Don't forget to add tax, delivery, setup, extended warranties if you had that. That's a true picture of the replacement cost, not just what it costs to replace. Remember, all these additional costs are what you're going to incur to buy that couch. So for all intents and purposes, we'll just start with the $10,000. That's the all-in price. Insurance company agrees. Now they're going to say, well, we only owe you the used value until such time as you replace it, and we'll pay up to $10,000. So they're going to apply depreciation. Well, depreciation is very subjective, very negotiable. Everything's negotiable, everything with the insurance company. And knowing how to position yourself strategically is the key to proper recovery. Understanding what your rights are under the policy and understanding those conditions and definitions is part of what we're talking about here. So the depreciation being, subjective and just, an unknown, they know, the insurance companies have done the math. They know that most people or all people are not going to replace every single line item that you lost. That's safe to say. So let's, for example, all the stuff in the garage that's been there for years, all the things in the top of the closet, under the bed, the junk drawers, all the stuff that we accumulate as human beings that we just kind of don't really care about anymore and wish we had dejunked. Well, now it's going to be replacement cost for all that stuff, subject to depreciation. So they know, again, getting back to my point I was trying to make, is they know you're not going to replace every single line item of everything that you lost. So they like to play a heavy role in depreciating those items because they get to hold, the insurance company gets to hold back that money until such time as you replace. Using the couch as an example, they agree to pay $10,000, and let's say they take $2,000 off for depreciation. You get a check for $8,000. Well, once you spend the $10,000 and show them that you've done that, they will pay you the $2,000 back. Now, if you can imagine, you might have 2,000, 3,000, 4,000 line items of merchandise in your inventory, and the depreciation could be anywhere $100,000, $200,000, $300,000. It's a lot of money. So don't take depreciation lightly. It is a very negotiable area, and it has to be looked at. And they'll look at every single line item. They like to do broad stroke depreciation. Now, the key here is in California, depreciation is not just for the lifespan of the item, not just the age of the item. The key is the condition of the item. So the newer the item or the better condition it's in, the less the insurance company can depreciate. And that's where it becomes negotiable. So they're going to want to know, was it in good condition, fair condition, excellent condition? Was it new? And that will drive the depreciation. Okay, very important. Okay, so that's the difference between replacement cost and the actual cash value. The actual cash value is the depreciated replacement cost. Hope that makes sense. Common inventory questions. Do I need to list every item? Well, to that I say, do you want to get paid? Now look, due to the firestorm, over the years, things have changed with the insurance commissioner. You can now categorize. Now, I don't know how many categories they have. It could be 70, 80, 90 different categories that you, instead of listing every single CD you lost or every single shirt, you can categorize clothing, X, furniture, X, whatever that number is. But if you list every item, it is a lot of work. It's how we do it. And we look at, again, the replacement cost and then depreciation and then the actual cash value. So listing every item is important only because of the detail. The more detail you hit the insurance company with, the less they can argue. So when you leave things open and vague, then it's subject to interpretation and they'll interpret it the way they want to. It's not to your advantage. Number two, what is a holdback and how does it work? Like we just spoke about, full replacement value, holdback, it's also known as FRV, depreciation holdback, withheld depreciation. These are the terms that you'll hear and you'll read when they send the letters off to you. So again, the couch example, that $2,000 depreciation, they're going to hold it, depreciation holdback, until you show them that you spent $10,000 to buy the couch today. And once you hand in that receipt, they will give you the $2,000. Now, look, this is a cat and mouse game you don't want to get into. This will take years off your life. Because if you can imagine a cubicle farm and, people just scrutinizing every purchase you make to see if they got to give you back that depreciation that they held back. So the way around that, hopefully and legitimately and defendably, is to get the number as realistically as high as possible, the replacement cost number, again, legitimately. And as long as you can defend it, and they agree, that's where it starts. And then again, you want to squash the depreciation. So for example, Chad, if we can go back one slide real quick. So in this example, see the base limit of 1.5 million. So let's say you do the inventory and it comes out to $2 million. That's your measured loss. And the insurance company depreciates 200,000. Now you're at 1.8 million. After depreciation, well, that 1.8 million depreciated value is above the base limit of 1.5. They pay you the whole thing. They commit to the whole thing. That's the key. How you get there is the secret sauce that you're going to need. So that's just a quick example of how you want to do it to avoid having to do the cat and mouse, hand in receipts, and that just drives everybody bananas. How do I get my withheld depreciation? I just mentioned it. You got to hand in the receipts, prove that you spent the money. Once they scrutinize the bill and the receipt, they will pay you back that money. Inventory tools and tips. Keep a pad and pen with you at all times, or your voice memo. Look, there's a lot of times, and I hear this all the time. And by the way, I was a fire victim too, 33 years ago, and this happened to me. You wake up in the middle of the night, or you're driving, you're dazing off, and you start thinking about what you lost. And you want to make sure you capture that at the moment. So keep a pad and pen with you at all times. Draw out each room one by one. In your mind's eye, do a walk around, visualize the drawers, the bureaus, the closets. Don't forget the junk drawers. I have 2 junk drawers at my house. If I was to inventory that, probably be $700-800 worth of junk. We tend as human beings to devalue what we own, and don't do that. Remember, it's replacement cost. So you want to capture and visualize everything that you can, including the shelves and drawers. Don't forget what was under the bed and dressers. Again, the junk drawers, everything matters. We count the toothpicks, for goodness sakes, when we're involved in representing clients. It's that detailed. Use family and friends. People reach out, they want to help. Put them to work. Research pricing, the items for you, and anything that they can do to help you out will ease the burden for you. Certainly, that helps. Photograph documentation and cloud storage. If you've had any parties or anything like that at the house, or some kind of event, doesn't matter if it's in the backyard, because remember, stuff in the garage and strewn across the lawn, that's all personal property. Things inside the house, maybe the curio cabinet in the back. We look at that and you say, what was in there? It's a memory jogger. You want to use any evidence you can to jog your memory. Last bucket of coverage is your loss of use. This is your temporary housing money, and it's one of 2 coverages. ALE means additional living expense, and it'll say that on your declarations page under coverage D, and that's your temporary housing money, and it also pays for furniture rental. Now, look, you're not going to go out and buy a whole house load of furniture if you're living in a temporary residence, because you don't know what you're going to go back with, where you might move to, how you'll design. You may want to redesign the whole house again differently. And so the ALE bucket of coverage, loss of use, pays for renting furniture. Of course, you're going to buy mattresses. You're not going to rent mattresses, but you do want to use that coverage to your benefit, because it's a use it or lose it bucket of coverage. And don't think for a moment, folks, that if you save money in this bucket of coverage, that they're going to give you more in the personal property or the dwelling. It just does not work like that. So use it or lose it. It covers increased mileage. There's an app out there called Mile IQ, highly recommended. I think it's about $5. And what it does is it tracks your comings and goings. Now, mileage right now is at 70 cents a mile. That's the rate. And the extra mileage that you're driving to and from the lost site, or to and from work, to and from dropping the kids off, if there's increased mileage, it's covered. And let me tell you, folks, it can add up to probably a few $1,000s at the end of this whole process. So Mile IQ will track your driving, and you swipe one way if it's for fire-related stuff, or it's called business under the app, and then you swipe the other way if it's just a personal thing. It's a great app, and that will track, and that'll substantiate and defend your position for your mileage coverage under loss of use ALE. Boat storage, RV storage, that's covered as well. Animal boarding, they pay for dogs and cats. Oftentimes after a fire, the housing, the hotels get filled up, and some hotels don't take pets, so they have to be boarded. That is covered. I don't think they cover fish and horses and cows. That's a different type of policy. I think it's a ranch policy. But nonetheless, your cats and dogs, if they needed to be boarded, those are covered. It's either a dollar limit or a time limit. So under that bucket of coverage, you'll see a dollar limit. Now, this is important. If you have $300,000 in that bucket of coverage, or $500,000, whatever that number is, you want to do the budget. You want to plan out for how many months you think this will take. Is it going to be 12, 18, 24? Is it going to be 36 months? how long is this going to take? And if I divide that by the number of months, that dollar limit, it's going to give you a monthly budget. You want to stay within that budget, because what happens is, for those of you that have a dollar limit there, once that limit is exhausted, the insurance company's off the hook. They're done. They fulfilled their obligation. Now you have to pay rent and the mortgage. Okay, and that can hurt really badly. So again, with the dollar limit, just budget it out. Make sure you understand how to how to use that coverage. Now, time limit, most policies have 24 months, but because of the Ricardo Lara's insurance code changes, it got bumped up to 36 months. And I believe there's some, with good cause, there could be some extension there. But if the money's out, if you run out of money in 25 months, that's it. Even though you have 36 months under the insurance code, once that dollar limit's exhausted, it is done, folks. So don't think for a moment that that doesn't happen. We get calls like this all the time. The other coverage is fair rental value. So for those of you that have that option, you do comps in the area of what your house would have rented for prior to the fire, and that's a number. And that's a defendable number. The comps would support it, and you submit that and say, hey, this is what my house would rent for. This is what you owe to put me somewhere else. Now, the key language is that they owe you for the same standard of living you had before the loss for the shortest period of restoration. That's what it says. Again, I'll repeat it. They owe you for the same standard you had of living prior to the loss for the shortest period of restoration. Well, what does that mean? Well, if you have a 3,000 square foot home with a pool in the back and all nice amenities, that's what you're entitled to. That's your standard of living. No more, no less. Unfortunately, there's a run on housing after a firestorm, and some people end up, having a little bit downsizing, some a little bit upsizing. It depends. It depends on the situation. It's all negotiable. And so the standard of living is your basis. And for the shortest period of restoration, that means once the insurance company cuts you what they believe they owe you for a settlement check on the dwelling, the tolling period starts. So the clock starts to tick. And somebody in management's going to make a decision that it'll take you X amount of time to rebuild this property. And so, they want to stop the bleeding in this loss of use bucket of coverage. And so oftentimes, once that check, that first actual cash value towards the undisputed amount gets cut, you want to find out what the tolling period is, and that's important because it does start the clock in most cases. So that's the difference between ALE, additional living expense, and fair rental value. Now, one last thing on fair rental value. There are a couple of policies out there, contracts, that will pay a cash out. Okay, what does that mean? Well, if the comps in the area are that your house could rent for $8,000 a month and you're going to be displaced for 10 months because it's a smoke loss, that's $80,000. They give you $80,000, and then you revisit the conversation later after 10 months to see if you're in or not back home. So that's called the cash out option under fair rental value. It's very rare because you cannot profit from a loss. So you can't be better off after the loss occurrence than you were before. And so a lot of companies got rid of this cash out option under fair rental value. It does exist still. Again, I can't mention who has it, but just check your policy or ask the adjuster if you have the option to fair rental value and get a cash out based on comps in the area. Now, the carrier also owes you the increased cost due to limited housing. We saw some egregious things in the Santa Rosa and Paradise fire. It was just such a run on housing. People were doubling rents, and I think they passed a law against that afterwards. But if there's an increase in rent due to the firestorm and the run on housing, they owe you for that. Here's some points, bullet points that you want to know. So how do I ensure I do not leave money on the table? Look, do not talk to the insurance company about your goals. These strategies that you have and the end result, end game of what you want to do with your money, look, it's your house, your money, your claim, it's all yours. You simply want to get what you're entitled to, no more, no less. And, talking to the insurance company about your goals will basically telegraph your position. It's basically, it's kind of like a card game, if you could look at it that way. Both sides are strategically positioning themselves. Look, and the caveat to all this is unless the insurance company just rolls over and gives you every dime that's in the policy, then it doesn't matter anymore. But so, understand that it's a game of strategy to a degree. You want to figure out what your end goal is. Are you going to rebuild there? What does that look like? Are you going to go buy a house somewhere else? What does that look like? Are you going to cash out and go buy a bungalow on the beach somewhere for the rest of your life? So those are all different goals that people have, and the way to move through that claims process differs. It's not all black and white. There's a ton of gray area here. Don't step on the landmines. Understand that what you say may impact your recovery. Know your policy. This is why we're having this webinar, so that you can understand how the policy really breaks down and responds. Meet with a claims consultant to explore your options, an attorney, or a public adjuster like us, someone intimately familiar with negotiating claims. Look, there's no cost, no obligation to talk to us, folks. If you have questions or you want us to review your policy, doesn't mean you have to hire us, but there's no cost for that. This is, again, what we do to give back to the community and help you understand, help yourself basically get through the process. We'd be happy to do that. My contact and our contact information will be available at the end of the webinar. Do I rebuild? Well, it depends on what your overall goal is and how your policy will respond to that goal. Do you have a mortgage? If so, what's the balance? That may play a role in the decision-making, whether you rebuild or not. What are your restrictions, if any? The code claim, right? Does it transfer? Or if you don't rebuild, is that important, and how might it affect your recovery? Should you buy instead? These are all questions and things to think about as you go down this claims process. If I buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? Next slide. I would urge you all to please take a screenshot. We have broken down the California Insurance Commissioner's consumer protection for wildfire survivors. These are the current codes, and it also cites the code section in the codes. So definitely take a screenshot of this stuff. This all applies to everybody. I'm going to take a moment and leave it there while you screenshot. Okay, next. Here's another screenshot you want. Okay, next. I believe this is the last one. Take a screenshot of this as well. Okay. I'm going to talk about the debris removal program, folks. This is a hot topic. Should I opt in, opt out of the debris removal program? What should I do? How does it work? Well, as you all know, all the lots are now deemed hazmat. And after every firestorm, the Army Corps of Engineers comes out, and you can opt into that program where they do it. The advantage of it is this: for most of you, you have a limited budget for debris removal, and it is not cheap. Remember, it's hazmat. Hazmat's expensive to remove. And so they'll come on your lot, neighborhood by neighborhood, street by street. It'll be scheduled if you opt in. I absolutely implore you to be on that site when they're there. With all due respect, sometimes it's like a bull in a china closet. It's a big hoe truck, and they're just digging down and getting rid of the debris. And if you've got driveways or walkways, areas that have not been severely damaged that can be salvaged because they're valuable, it could turn out that they can become damaged from the debris removal people. So opt in. Again, the good part is this: let's say you have $100,000 limit for debris removal, and a bill comes in and it's $175,000, and you've opted in. Well, the bill comes in, they will pull the 100,000 from the debris removal section of the policy. That goes to them. For those of you that get paid from the insurance company, please allocate that, separate it, put it in a separate account, and hold it there, because eventually this bill will pop up for the debris removal. And so the bill comes in, it's 175,000. You give them the 100,000, or they pull it from the policy, and the difference, in this case 75,000, is subsidized by the federal government. And so that's what happens there. And that's the beauty of doing it. What's the downside? Well, the downside is that you have less control. At the end of the process, no matter whether you have a private contractor or you have the Army Corps of Engineers do it, you need a clearance certificate. A certificate of clearance in your hand will deem that lot buildable lot. So if you choose to sell the lot, pay off the mortgage, sell the lot, and move, that certificate is worth its weight in gold, because it's basically certifying that that lot is clear and free of hazmat. That's a really key piece of that. Now, opt-in is good for, again, those that have limited budgets or smaller budgets for debris removal. And I would highly encourage you to opt in. And again, be there on the site when they're there. And so you got eyes on your property, making sure that things are going okay. Don't just do it blindly, because you don't want a surprise when you get there. Next one is opting out or going into a private debris removal company. Now you can do that. We have seen policies that have $300,000, $400,000, $500,000 for debris removal, and that's a lot of money, right? And so they can hire a certified hazmat debris removal company privately and have more control. So that's the difference there between the two. But if you do the private contractor option, make sure that they have a certificate or a license rather for the hazmat removal, because ultimately they're going to have to go down, pull permits, show it, so that you can ultimately get your certificate of clearance. Very, very important. That's kind of an overall overview of the debris removal program and the pros and cons. That's pretty much it. I'm going to open it up for Q&A. If there's going to be some questions, I'm sure, coming up. This is my contact, my cell number direct, my email. If you'd like a one-on-one consultation, I'd be happy to do that. Again, there's no cost. There's no obligation to hire us. It'll help you understand things a little more clearly. Everybody's cases are all different. Everyone has different goals. The policies are quite different. The limits of insurance are different. The options may be different. So be happy to discuss that. Okay, let's open up for Q&A. Okay. First one is, which bucket is an office that is a single room connected to the rest of the house by a roof over a breezeway? The breezeway roof is an extension of the roof of the office. Is it part of the main structure, or is it other structure? I would consider that part of the main dwelling. And usually you want that to be, because the main dwelling has the bigger amount of coverage. Let me just read that again. Which bucket is an office? Yeah, I would have to say that's part of the main structure, because it's connected by a roof. Yep, that's my answer to that. Next one is, if I'm staying in my second home, can I receive compensation for rent from my insurance company? How is the amount determined? So first of all, I've seen it happen plenty in Santa Rosa. And so staying in a second home, what we saw, and I'll just share with you quickly, we saw people of means in Santa Rosa that had second homes. They ended up having their tenants move out, and they moved into their home. Now, it wasn't the same as their primary dwelling, but it was a home that they know and they could care for. And as long as you're transparent with the insurance company and letting them know that it's your second home, they'll either accept or deny, or kind of structure it in a way that may make sense so that they'll pay it. But I would implore you to understand that transparency is the key here. And sometimes what I saw also is that the second home is listed under an LLC or maybe it's managed by a property management company so that the payments are not going to you, because remember, you can't profit from a loss. So the payments go to a property manager, or the payments go payable to the LLC, and it's separated from you. So you're the named insured, but the payments are going to somebody else, even though it is your second home and you're staying there. Again, talk to the adjuster and be as honest and transparent as you absolutely need to be. Absolutely need to be honest and transparent, and that way you can get a good answer in that. The amount is determined by comps, basically, of what the going rates are in the area. Again, these are all negotiable things. Everything's negotiable with the insurance company. Next question is a large crystal chandelier covered as structure or personal property? That is attached to the structure, so that would be your structure. Again, remember, if you tip that house upside down and shook it, and the chandelier is attached to that ceiling still, that it's not, it's part of the dwelling. Wall sconces, same thing. Your dishwasher, it's plumbed in. Your stove, gas stove, is plumbed in. Those are part of the structure. Okay. The loose stuff is the furniture, the dishware, the laundry, the beds, that kind of stuff. So the chandelier is covered under structure. And again, usually the structure has more limit than the personal property. So that could be a good thing. Next question. Hi, Daniel. Thanks for joining. Rocket Mortgage has now received from insurance company an amount nearly equal to the amount I owe on the mortgage. So it seems this mortgage is now secured by cash, which is safer than it was secured by the property. True, but Rocket will not pay interest on the money they are holding, and yet are still charging interest for the mortgage. Correct. They will grant 3-month deferral. Yep, that's nice of them. Of payments. Do we have any recourse to receive interest or not pay interest? That's a good question, and it comes up often. I would have to say, have them show you in writing where it says somewhere in the catastrophic loss section of your mortgage contract. Every contract has some kind of a destruction clause that lays out what happens if the home gets destroyed from a covered peril. So, and look, if it's not there, then they may have Rocket may have their own business model. It just doesn't allow it. But if it's in writing, have them show it to you. So I'm not sure if they're interpreting or contracting correctly. I would start looking at contract language. That's what I would do. Next one is, my home burned to the ground and it was a rental. I have fair rental value based on rent my tenant was paying. The policy was based on a year's income. The home will take longer than a year to build. Do I qualify for any additional year of loss of rents as homeowners do? So it depends on that's a good question. It depends on if you only have 12 months. Okay. So if you only have 12-month limit, then that's all they owe, because it's a contract. Let me just read this again one more time. I'll take one. I have fair rental value based on, okay. So if they're paying what you were getting on rent, then they owe you that moving forward. And if it's deemed that, again, if your policy has a dollar limit or a time limit or both, once that 1-year time limit runs out, you will be they're done. They've filled their obligation under the contract. And I don't know, unless you're asking if there's an additional coverage, there may be an extension. But if you look at the insurance codes, most of those are for primary dwellings. Excuse me. Most of those are for primary dwelling laws that have changed. So again, look at the time limit on the policy, see if there's any extensions available for good cause, and make sure they're paying you what you're truly owed for the loss of rental income. I hope that answers the question. How can I ensure, the next one is, how can I ensure that depreciation applied to my property is accurately calculated? Well, that's a gray area, and that's negotiable. So remember, they're going to try, the more they depreciate, the more they keep if you don't replace the item. So you want to look at every line item that's depreciated, and it's going to be mostly based on the condition of the item. So if you're accurately describing the condition of that item, then that should limit. So again, if it's in good condition versus poor condition, a good condition is going to be less depreciation. If the items are new, there's no depreciation. So that's really important to look at every line item because it adds up into tens of thousands of dollars. Next question is, what steps should I take if my insurer is unresponsive or delaying my claim payout? We hear this a lot. Look, there is an insurance code that, and if you took the screenshot, you'll see it in there. The adjuster has 15 days to respond, folks. Like it or not, that's what the code says. So I get calls all the time. I've called my adjuster 3 times. I've emailed him 5 times this week. He's never gotten back to me. Well, they have 15 days to respond. As far as if they're unresponsive after 15 days and delaying the claim payout, well, to that I say, you, the consumer, have a right to have it reassigned to another adjuster, and hopefully a better one, or get the claims handler, the claims examiner, the claims manager on the line. See if you can get a hold of that person. Some of these people just don't have the authority to make decisions, unfortunately, because it's such a huge event that some of these people may not have the experience necessary to make or have authorization to make decisions. And so they have to wait for the boss. And you can imagine there's stacks of paperwork to go through. So, but you do have the right to have it reassigned. And as far as delaying the claim payout, I would have to say that there's got to be a reason for that. Either they need more evidence, meaning they need more information to process your claim. They don't just hold the payout for no reason. Okay, next one is, can my insurance company force me to repair instead of replace the damaged property? They cannot force you to do anything. It's your claim, your money. As long as you're operating within the 4 corners of that contract, you're good. And as long as they're operating in it, they cannot force you to repair. If you want to get the insurance money and live in it the way it is, if it's a smoker, it's up to you. And replace the damaged property. It depends on what you're talking about, if it's contents or the building, but they can't force you to do anything. There's rules and regulations, certainly. And remember, the insurance policy is a contract. Next one. Hi, Judy. If we have coverage for a duplex and want to buy rather than rebuild, do I have to purchase a duplex? Same type of dwelling? Or could it be a single family? That's a good question. It has to be like kind, as far as I know. Look at the language under the condition of payment. It should be in that section of the policy. Judy, I'd be happy to look at it for you if you like. Just get a hold of me tomorrow morning or something. We can get a PDF and I'll look at that. But that comes up a lot. So another question to that same point is, if I have a single family dwelling and now, because I'm older, I want to take the insurance money and buy a duplex, live on one side and rent the other, well, that's a problem. So it has to be like usage is what my understanding is. But again, looking at the policy will kind of dictate that. Judy, again, if I want to buy, can I purchase property? Oh, if I want to buy rather than rebuild, can I purchase a property which costs more than the combined dwelling, other structures, code replacement, landscaping? What happens? Yes. Remember, there's a limit. So if you have an all-in limit paid out, all the money, every penny's been paid and accounted for, and it's $3 million, for example. And the insurance company has given you every penny that you're owed. There's no more money to get out of that policy, Judy. And you want to buy a $5 million building, have at it. It's up to you. You can do that. You can spend the money the way you need to on that end of it. I just want to read it again. I want to make sure I'm answering the question. If I want to buy rather than rebuild, can I purchase a property which costs more? Yes. Yeah, you can do that. Yeah, you look, you have to get them to commit, Judy, first of all, to the money first. So once they're on the hook for it in writing that they're committing to that amount of money, now you know what your budget is. Okay, another one from Judy. These are great questions, Judy. Thank you. Are there any special issues if I rebuild on another site? My answer to that is no, there should not be. Again, read that insurance code. It's quite clear on, they used to strip away the land value and now they can't do that anymore. So that's part of that insurance code. No, the benefits, Judy, on that part of it follow you anywhere. You can move to Idaho, Vermont, New Hampshire, Montana, Utah. You can go anywhere and use that money. Do I get to keep the land of the original property, or is there an offset of some sort? So if you have a mortgage, Judy, on that property, assuming you have a mortgage, then you got to continue to pay the mortgage on that piece of land. If you don't have a mortgage, then the land is yours. You get the deed, right? You got the money. There's no partner in it to dictate what what you have to do. So you can take, assuming you don't have a mortgage, you get the insurance proceeds, you do the debris removal. Now you're sitting on a buildable empty lot. And you can hold on to it for as long as you want until somebody comes along and pays good money for it, if that's your goal. And then you take the insurance proceeds and you can go build elsewhere or buy elsewhere. Another one from Daniel, is a pergola that was attached to the main structure by metal bracing considered part of the main structure? That's a good question. It's a pergola. I don't know. It could go either way. The way I would look at that, I would say the pergola would be considered under normal circumstances a separate structure. But if you've blown through your separate structure coverage, Daniel, maybe you try to get the adjuster to agree that it's part of the building loss. Remember, everything's negotiable. I've seen all kinds of stuff. Unless it's a stickler, the guy says, no, it's clearly defined as it's a pergola is considered a separate structure, then it's going to fall under that coverage B. But again, I would try to negotiate that. If you're out of money under the other structure bucket, you try to lump it into the dwelling bucket. It's all an argument, I guess, at the end of the day. It's how strong your argument is and how you position it. And look, these people are trying to get their claims processed. There's a lot of errors. You're going to find that on the scope of repair that they put together, oftentimes you're going to see that windows may be missing or the dimensions are wrong. Do yourself a favor and really dig into that scope, because you want to account for every linear foot, every square yard of whatever you had in there. Remember, they don't have to be accurate, guys. You do. It's very important. It looks like that's the last of the questions. And I want to thank everybody for joining this evening. I hope I was helpful. This is the 4th webinar of 8. We will have these on Wednesday night at 6:30 moving forward for the next month. Another 4 webinars. Please spread the word. If there's anybody, friends, relatives, anybody that you know that's been impacted by smoke or fire damage, send them over to the webinar and be happy to share our information and help yourselves through the process. I wish you all the best of luck. Hang in there, be patient, and hope to hear from you. If you have any questions, be happy to answer them on a one-on-one. Have a good evening. Thank you.